From your end also, you can record it,
I
sir?
think, yes,
Okay.
started. Okay.
Okay, sir.
So, where are others? Oh, already joined. 124 participants. Okay, okay. You can
Yes.
start.
Okay, sir. So, very good afternoon to everyone. We meet again at the last session of today's refresher course. And we're indeed very grateful to have with us as a resource person, Professor Bhartendu Singh, professor from the Department of Commerce, Mizoram University, who will be talking to us about insurance, as insurance is a very, very important aspect when it comes to disasters, especially. So, Sir has a teaching experience of over 20 years, teaching and research experience of over 20 years. Sir has published more than, a lot of papers in different reputed journals, and we cannot, inform you about all the, papers that he's published, but a good number of papers, books, and Sir has also, successfully guided a lot of PhD, MPhil scholars, presented many, many papers in different reputed institutions. And for me, especially, Sir is a personal mentor and a personal guide to me, especially. So I'm really very thankful that Sir is with us today. And so without wasting much time, Sir, I would like to hand over the time to you, Sir.
Okay, thank you. Thank you, Minga, Dr. Minga. So,
Thank you.
so good afternoon to all the participants. I am seeing nearly 130 of you are here. So it's a good number. It's a very good number, encouraging number to start with. So today, as Dr. Minga already informed, we are going to talk about insurance and disaster management. My focus will be more on insurance because disaster management you are already doing in other sections, but one or two slides may be there on disaster. But as you know, if you are going to face any disaster, you need to overcome those disasters. And insurance is one way to overcome. It's one way to mitigate or just to handle the problem, the disasters. Certainly, psychological problem created by disaster cannot be taken care with help of insurance. Only time and friends and relatives can do those. But as far as financial loss is involved with disaster, whenever a disaster is happening, usually there is financial loss also. So here, insurance may come forward to help you come out of that. So we will see this disaster management from point of view of insurance, and I will focusing more on insurance. And later on, I will be focusing more on life insurance. But something I will be talking about general insurance also. So let's start a small journey, joyful journey. I hope you will enjoy this. And if you are having any question, you may please put it in the chat box and question answers is please. And by the end or in between, I will keep on taking those questions and I will try to answer those things whatever I could. So I'm going for the screen share now. I hope it must be visible to all of you.
It is visible, sir.
It is visible. Okay. So we'll talk about insurance and disaster management. As Minga already informed, I am Bhartendu Singh from Department of Commerce. And if you see in the background, lots of umbrella is there. So it is not just because it is colorful I have taken. I took it for a reason that whenever I see an insurance, I see it as an umbrella. Why umbrella is required? If there is a rain, if I have to go for a certain very important task, and if rain is there, it may disturb whole of my plan. So umbrella is there to help. It doesn't mean that if I'm having umbrella, it will not rain, or if there is no rain, why to carry an umbrella? Umbrella is required just for protection. So same thing, insurance is there. It is required if it rains, if something wrong happens, then only insurance will come forward. So whenever I think of insurance, first thing comes to my mind is an umbrella. First thing comes to my mind is a parachute. So let's go further. Let's see some disaster related thing, what is happening in India. And you know, many other sessions you must have seen different kind of disasters. Some are man-made, some are natural, which are occurring in India, and we are exposed to those things. And some data is there. That is nearly 60% of the land mass is susceptible to earthquake, and that is moderate to high, and whole of Northeast is under that. Some 12% of total land in India is exposed to floods and river erosion. Some out of 7,500 coastlines, 5,700 is prone to cyclone and tsunami. And we have seen every year it is happening. Frequency is increasing for all those things. 68% of the cultivable area is exposed to drought. If proper rain is not there, then drought will be there. And hilly areas are at risk of landslides and avalanche. All those things are exposed. We are all exposed to all these things. Sometimes it is natural and sometimes it is man-made. But as far as the disaster is concerned, as far as the effect is concerned, it is same. We are going to be affected. Now think what we make all kind of plans, thousands of plans, hundreds of plans we create every day. What if the person, the breadwinner of the family dies? If something happens to him, what will happen to all of his family, all his dependents? When we plan, we are good in health, we are fine sitting at place, so we are planning. But what happens if something wrong happens, isn't it? At that time, insurance will come and help. Now, what is insurance? And I don't need to introduce what is insurance. You know, it is a kind of policy, it is a kind of contract between the company and insurance company and the individual who is taking this insurance. And it is just to manage the risk. It cannot reduce the risk. It cannot eliminate the risk, but it can manage the risk. The financial part, financial loss involved in this disaster can be managed with help of risk. What happens here is everyone, all policyholders, pay some amount, some fee in the name of premium. So you are supposed to pay either a single premium or more than that, or regular premium. And if anything wrong is happening, if anything, some disaster is happening, then you will get some compensation, financial compensation. So certainly not psychological. Now, if I see this life insurance from a commerce or management point of view, it is part of financial planning. There is a term called financial planning. So financial planning is what we try to do under the financial plan is we create a plan where I want to fix my priorities, where I try to see what may be my goal in future and how I can achieve those goals. That way we see financial plan. Right? So let's see what this financial plan is. Now, this financial planning is nothing but a roadmap. I'm standing at this stage, at stage 1, and I want to go to stage 2. So this is my financial plan. So I need to prepare a plan so that I can reach the place where I want to go. Fine. So that is the basic concept of financial planning. If you go in detail, it needs few sessions, 4-5 sessions to understand the concept of complete financial planning. But in brief, you can say it is a plan to achieve the place financially, what I want to achieve. Fine. Same thing is given here also. It helps you to manage your current income. It tries to channelize your current income in such a way that you can reach your desired goal. It will help you. It cannot ensure it, because planning, you know, it is for future always. So future is always uncertain. But it may help you to reach that place. If not exactly that place, so nearby you can reach with help of financial planning. Now, if you see some major financial goals, what we are having in our life, we don't go much in detail of all those things, but these are the major things. So after this session, when you are free, this is last session for today. Close your eye, 20 minutes, and think what you want to achieve till your retirement. And then jot out on a paper, what are your goals? Then after writing just 5, 7, 10 names, try to identify how much expenses required into this price. Then try to convert those things according to the prevailing interest inflation rate. What may be costing at that time when it will be due. Okay, and accordingly you can create a plan. Fine. It is a lengthy process. We are not going in that. In some other session, we may talk about this. So these are just indicative, but your plans may be having more than this or less than this. And now, what happens with our financial planning is we plan everything. And if you remember what I told in the last slide, that try to jot down the name of your goals. What are the goals you are having, and what is its cost today? Just suppose you want to purchase a house after 5 years. Okay, and you are having a very good picture in your mind of 50 lakh rupees house, right? But after 5 years, when you go to purchase that house, you will be unable to purchase. You are having 50 lakh rupees, but you may not purchase. Reason is inflation. I cannot say inflation is a disaster, but if we talk about financial planning, actually inflation is a very big disaster. It can collapse all your plans if you are not properly understanding it. Inflation creates this time value of money. Fine. So let's try to understand with example what this time value is and how it is going to impact, how disastrous it can be for your financial plan. See, I'm taking one example. If your monthly expenses today is 25,000, and just suppose you are retiring after 35 years, and if inflation is 7%, in that case, what will be your expenses when you retire? And it will be 2,67,000 rupees to maintain same lifestyle what you are having today. Fine. So your 25,000 rupees monthly expenses will be 2,67,000 after 35 years. If it is not disaster, then what you will say at disaster, isn't it? Okay, let's see one more example, a reverse side of this. If you get say 1 lakh rupees after 35 years, when you retire, we are taking actually some small insurance policies you must have taken. Just suppose after 35 years it is maturing, it will give you 1 lakh rupees. You feel 1 lakh rupees is 1 lakh is a good amount, and you will do this or that, a bike, something you will purchase out of this 1 lakh. Right? But when you retire, when you after 35 years, this will be worth just 9,366 rupees. Same 1 lakh, you will be receiving 1 lakh rupees. But with that 1 lakh rupees, you will be able to purchase products worth rupees 9,300. Not even a good mobile will come in that. Fine. So that is the thing. So whenever you plan anything, keep in mind inflation. Let's see some more examples on that. Make this concept of time value more clear to you. If you want to earn, if you want to make a corpus of 5 crore rupees, if you feel that the time you retire, you should be having at least 5 crore rupees in your retirement savings. And you are having 35 years till your retirement. And you are expecting that some 15% return you can earn. It is little high. Actually, I should assume somewhere 10 to 12%. But just for example, I'm taking 15%. Then what you have to do is you have to invest 3,400 rupees per month for next 35 years in a place which can generate 15% return. And finally, you will be able to secure a safe 5 crore rupees. Right? But the problem is we always late in starting savings. Okay, let us delay our saving by 10 years. Not now, start after 10 years for same 5 crore rupees, but now you are having 25,000 and 25 years only and 15% return. Return is same, but you need to save 15,000 rupees. To start today, it is 3,400, which is very much easy to start with. But 15,000 may be a little difficult to handle, isn't it? What created the difference is inflation, the price rise, or the time value you can see. And let's see some more examples on that line. Let's see one more example on some sorts of saving we are doing and how it can generate income for us. Okay, so I'll give you one example. It is a government-backed scheme, so there is no risk at all involved with this. Later on, I will tell you one of the risks. So the scheme is KVP. You might be knowing this name, Kisan Vikas Patra. This is available in post office. Go there and you can invest. And the concept is the KVP principle is whatever amount you invest today, it will get just doubled after some fixed period. So as of now, fixed period is 10 years and 4 months or 124 months. In this period, whatever you invest today will be doubled. So if you invest 25,000, it will become 50,000. Right? So what I'm suggesting you is you start investing 25,000 rupees per month. As soon as you get your salary, go to post office and purchase 1 KVP of 25 and come back. Next month again you go and purchase another KVP 25 and keep on doing this for next 10 years, 4 months, every month. Okay, same thing, keep on continuing. What happens? After 10 years and 4 months, your first installment of your KVP will mature. What you have invested in the first case, after 10 years, it will mature. It becomes, you get 50,000 rupees. Now I'm suggesting you, what you do is don't carry this 50% home. Immediately you get 50,000, reinvest 25 and do whatever you want with your remaining 25,000. You may give it to me also. Up to you. Just joking. So 25,000 need not be out of your pocket now. Initially for 10 years, 4 months, you have done out of your pocket 25,000 per month. But now onward, every month, 1 KVP will mature with 50,000 rupees. So out of this 50, keep 25,000 with you and invest 25,000. And that cycle will continue. Every month, one will mature and you reinvest. And the cycle will keep on going forever. This is a very, very, very attractive scheme, right? But let's see the disaster part in this, the impact of inflation or impact of tax. Invested today is 25,000. And after maturity, 10 years, 4 months, you will be getting 50,000 rupees. But as soon as you get this amount, income tax department will come to you and they will ask 30% tax on that, if you are in 30% bracket. So 7,500 rupees will go as tax. What remained in your hand is only 42,500. So no more 25,000, 25, isn't it? Here I told you, you invest 25,000 and you get 25,000 additional interest over that. But no, you are invested 25,000, but you got only 42,000, not double. And even difficult part, even more severe thing under this is the inflation, the bigger villain. And that is this 42,500 rupees after 124 months will be worth only 20,600. How much you invested is 25,000 and it become only 20,000. Is it an investment or is it losing money? I call it losing money. But actually people are rushing for KVP kind of schemes, considering it doubles your money. But we don't see how much time it is taking to double. And we ignore inflation, the time value. So whenever you think of any kind of investment, think of tech and think of inflation. And let's see one more example. This will make the concept of this time value little more clear. These schemes are there. First scheme, you invest 5,000 rupees per month for first 10 years. Then you start investing 15,000 rupees for next 10 months. And then you start investing 50,000 rupees for remaining 10 years. Okay. So this is total scheme for 30 years. Okay. Then next scheme, you invest 10,000 rupees per month for whole of the period of 30 years, same time duration, right? Or a third scheme is there that you invest little more, 14,000 rupees for initial 10 years and then no investment throughout the period, remaining 20 years. Whatever scheme you choose, your final amount will be 3.5 crore rupees, right? Provided you are able to get 12% return on this, and 12% is very genuine. That much you can do. So if you want to invest or if you want to generate 3.5 crore rupees, any of these schemes you can choose. Invest 14,000 for first 10 years and relax for next 20 years and you will be getting this. Now see the difference, why I'm giving this example. If you invest fixed amount for whole period, a longer duration you are investing. Okay, in this case, 5,000 you are investing initially, a smaller amount, and then you have to increase it further. But here, little is bigger amount you are investing initially, and then further you are not investing anything, but still you are able to reach at this stage. Reason is for this third stage, third case, you are giving your savings to grow more. So important thing in your investment is give time. It is a kind of tree. You sow mango tree, don't expect next year you will be eating mango from your tree. It will take time. But once it will start growing, it starts giving you mango, not just for eating, you can do business over it. And so give time to your investment. Now, I hope most of us are covered under NPS, new pension scheme, and you might be very happy that NPS is a government-backed thing and you are generating good return on that and all those things. Let's see the reality behind this NPS also. Let's try to see the future. I'm assuming certain things like your present income, basic pay is 57,700 rupees. So 10% of this will go to NPS plus some amount government, matching amount government will pay. So I'm assuming it is coming 11,540 rupees. Okay. Now I'm assuming that salary will increase. There are one increment and two dearness allowances are there every year. I hope no more seizure of DA will be there. So roughly 10-12% it will increase. And then your promotions also will be in the place. So I'm assuming your investment in NPS will increase by 10 to 12% every year. If you are 30 years today, your retirement is 60 years, so you are having 30 years for this scheme. And if you can generate 10 to 12% of return, which is possible, as of now, NPS is giving somewhere 10% return. So if it continues with this or little bit improved, then your final corpus will be 7.5 crore rupees. That's a huge amount, isn't it? Really good amount to retire. Let's see how effective this amount is. This is 7.5 crore rupees and NPS, if architecture you understand about NPS, there are two things after retirement. Either you withdraw some amount and invest something in annuity or invest 100% in annuity. That is up to you. Certain mandatory thing is minimum 40% you have to invest in an annuity, minimum, not less than that. You can do more than this, 50, 60, 70 or 100% you can do annuity, but not less than that. Right? So two cases I am taking. If you are withdrawing 60% in cash and 40% only you are investing, or you are investing all 100%. Both the cases I am taking. If you are going for the first case, withdrawing 60%, then your monthly pension will be 2,21,376. Good enough amount to survive, isn't it? Your salary may be less than this amount. So pension will be higher than what your salary today you are getting. And if you invest everything in annuity, then you will be getting more than 5.5 lakh rupees per month. Huge amount. But let us see how huge this amount is, because you have to survive further some 20, 30 years of. So I'm assuming there is inflation of 7%. Okay. How much you will be getting after retirement and how much it will be after 10 years. So at the time of retirement, you will be getting 2,21,000 rupees. That will be worth less than 30,000 rupees of today. So you can maintain a lifestyle of 30,000 rupees. Fine, it is possible to run. But time of retirement when you are 60, when you become 70 years, the same amount will be worth less than 15,000. That will be a problem to survive. Fine. So you need to invest in that. You need some kind of insurance. Insurance policy will not help here, but your investment policy will help. right? So these are the disasters we are going to face in our life. After our retirement, our income will be less. We need to plan for that. Fine. Go further. This is one indicative chart I have taken from the website of NPS today itself. This morning only I have taken. So you can also visit and take these things. So these four options are available in NPS. Uh, Annuity payable to whole of your life or the person who is covered under NPS. Second is 100% annuity to spouse. Spouse means if husband is working covered under NPS, so his wife also will be getting 100% of the annuity, whatever is coming. Now, other two are annuity payable to wife, life with ROP. ROP stands for return of principal. Whatever you have invested, that will be paid back to the dependent. So third option is annuity you will be getting till you survive. You means the person who is covered under NPS. Till he survives, he will be keep on getting annuity amount. And after his death, the dependent will be getting whole of the amount what is invested. And fourth one is 100% annuity to spouse with return of premium. Okay, so if husband is covered under NPS, so for whole of his life, then if he dies early, then his wife's life. When wife also dies, then whole of the amount what he invested initially will be transferred to the dependents. If you are having a corpus of 1 lakh rupees, then you will be getting 713 rupees pension. You will not be having corpus of 1 lakh rupees. Mind it must be in crore, around crore it will be. So accordingly, you can multiply, put two zeros if it is 1 crore. Okay, so 71,300 you will be getting for whole of your life. Okay, but if you are taking with his spouse, then it will be 61,200 rupees. Right? And if you are taking the return of premium, then it will be 5,000, 52,000 or nearly that much. Right? So think of these options, but the time you are going to retire, actually these things will change. But keep in mind so that you can decide what you can do. But my suggestion is always think of either first one, second one, or the fourth one. That is our prime objective. Cover spouse also. Right? Okay, let's go further. Now let's come back to the insurance planning. You will be thinking that it started with insurance and I'm talking about something else. So let's come back to insurance and let's see this parachute. Why this parachute is there? If you travel in a flight, if you travel aboard in a flight, always you will be informed that there is a parachute below your seat. Okay, and you know whatever service we are getting in a flight, everything is being charged. So we are paying some money for maintenance of this parachute every time we are boarding in a flight. How many of us wants to use this service? None of us. We don't want to use that parachute because we know in what circumstances we will use it. That will be a very, very serious situation, isn't it? So that is the thing, is the insurance. Don't feel that you are paying some premium, so I should get some return over that. It is not like that. It is only there for your help if anything severe happens to you. Okay, someone has raised hand. If any question is there, you may put in chat box. I may respond to that. Okay, so someone is asking, is there any method we can save money where inflation effect will be negligible? So there is no such case because whenever you are saving money, you are saving it for future. And as time passes, inflation will always be there. So there is no such case. Only thing what you can do is invest in a place which can generate in return more than inflation. Assume inflation is 7%. It keeps on going up and down. So invest in a place which generate more than 7% return, more than 8% return. And if you consider tax also, so more than 9% return, then you will be able to beat inflation and tax both. Uh, Someone is asking on what basis I am arriving at 7.5 crore. So those things I have given the 57,000 rupees, some basic pay is there. So the 10% of that will go in NPS account. Then government will pay matching amount, and this will go every month for next 30 years. And that will be invested in a place which generate 12% return. If it is happening for next 30 years, then it will be 7.5. So that is based on certain formula for which I have calculated it for us. Which way we can invest? So there are many ways to invest, but don't invest in insurance. Insurance is just for insurance, for some risk cover. I will explain this concept later on. Invest in some mutual fund, invest in maybe real estate, invest in gold, invest in equity shares, but invest at a place where you understand and which is able to beat inflation. Someone is asking if I suggest mutual funds. So certainly you should go for mutual fund, but I will not suggest name of any mutual fund. That is not my work. But you go to certain websites and read about mutual. There are different kind of mutual funds. Equity mutual fund is there, debt mutual fund is there. Within equity, large cap is there, mid cap is there, small cap is there. So choose, if you are starting, if you are beginning, then go for a large cap mutual fund, large cap equity based mutual fund for long term. Okay, that will be starting point, and gradually you will start understanding mutual fund and you can expand it. Someone is asking, as a teacher, as a professor, we don't have choice to do business. Then how we can survive with? We cannot do business, but everyone is not doing business. So out of your salary, of your income, you can make certain investments, and those investments will generate income. If you properly invest in a proper place, it will generate income which will be enough for survival. Fine. Someone is asking what are the best policies for investment at present. So we will come on this point little later. Okay, so that is the concept of insurance planning. That's a statement. I found it in some website of insurance policy only. In case you can't be there to catch them, make sure you leave a safety net. So I feel this statement explains everything. This picture and this line explains whole concept of insurance. So it is a safety measure. Some roughly, I will a little fast. I will go for these concepts. These are some basic things about insurance. If we see compare insurance in India with other part of world, then this is life insurance. This is non-life insurance. So at world level, if you see total insurance taken, 46% insurance is going for life, and 53% or 54% is going for non-life. Advanced markets 44, 55, little lesser than that. Emerging markets 53, 46. If you see Asia Pacific, 63% of total insurance, 63% or nearly 64% is for life and 36% for non-life. But if you see India, it is nearly 75. Every third policy out of 4 policy, every third policy is a life insurance. And only 25% premium is going for non-life policy. And my assumption says that out of this 25% non-life policy, majority is going for third-party insurance of vehicles because it is mandatory. You cannot ignore. So mandatorily we have to take. So majority of the amount goes there. So actually non-life part is not properly covered in India. That has to be. We have to start, we have to begin with life insurance, right? So let's go further. This is just giving you an idea that how many companies are working. So 23 companies are there in private sector and 1 public sector, that is LIC, dealing with life insurance, 24 companies. General insurance, 26 companies are there, different companies, although we don't know all those things. Now, this is one idea, one thing, insurance penetration in India. This penetration means it is what percentage of premium is GDP is premium. So it is in percentage. If you see this red color, orange color line, it is non-life insurance. That is less than 1% of total GDP. And this blue line covers life insurance. That also is less than 3% as of now. For some time, it has crossed nearly 4.5%, but it has again around 3% only. So out of total full GDP, only 4% are there, or you can say nearly 4%, less than 4% of total insurance. Let's see this at international level. What is the scenario? As per latest IRDA report, this is giving India, just suppose, is coming up to this stage. And see other countries, how long or how much coverage they are having. India is somewhere standing at this stage. All these countries are going much, much beyond that. You can say India is less, what to say, insured country. Let's see it from a different point. It is insurance density in India. Density means per capita premium. Total premium paid, life and non-life together, divided by population. That is per capita premium. So that per capita premium is obviously increasing trend is there. But this again, this orange line is non-life, which is less than 20 US dollar, $20 only, less than $20 per head. Blue is the life insurance, and that is less than $60 per head. Let's see it at national, international level. What is the situation? See, India is almost ignorable state. This much only, very, very less. So you can say India is heavily uninsured or heavily less insured country in world. So a very good scope is there for expansion of insurance. The problem is we don't understand insurance properly. We don't understand how it is required and how what else we can do with this. Okay, so some more questions are there. Which are the best policy for investment at present? I will not tell you best policies. Only thing the trained mutual fund, if you are talking about, I told if you are initially starting, go for large cap equity mutual fund. And if you are already expert, you must be knowing you can take some exposure to small cap or mid cap. Or your savings, actually, some amount you should keep in liquid form, what we used to saving bank account, that you can transfer into liquid fund, liquid debt funds. Okay. Someone is asking, are buying of equity shares or mutual funds prohibited for government employees? It is not. You are encouraged to do this. If you remember, under Section 80C, ELSS is there, equity linked saving schemes. So that is a mutual fund. If you invest there under Section 80C, you will save some tax also. So absolutely not restricted. You can go for it. What about investing in stock regarding companies? Stock, if you are a beginner in investment, don't go for equity shares. Go for mutual funds and read about equity share analysis. Choose a proper company, then only go for it. Initially, don't jump into shares directly. Go for mutual fund initially. Okay, now this is some risk exposure. I'll go a little fast on this. Personal risk is there, like premature death. Everyone knows about this. Poor health and insufficient income. Property risk is direct loss or indirect loss. Direct loss is, just suppose I am having a house which I have given on rent. So if that house collapses because of earthquake, so direct loss, my 50, 60 lakh rupees investment is gone. That is my direct loss. Then indirect loss is I was generating some rental income out of that house, and now I will lose that also. That is indirect loss. Same thing for car. I'm having a taxi, running a taxi. Taxi is stolen. So direct loss is loss of the vehicle. And indirect loss is now I will fail to earn anything. Okay, so that is indirect loss. So property loss. And liability risk is personal liability or professional liabilities. Okay, let's go further. Now let's try to see the four quadrants of risk management. What we can do in what cases. Let's see first severity of the disaster. Severity may be low or it may be high. So low severity, the first two columns, and next two columns are high severity, right? And on y-axis, we are taking frequency. How frequently this severity, this risk is coming to you. It may be high on higher side, low on lower side. Fine. So frequency lower side is low and upper is high. Fine. So these four quadrants are there. Where four combinations are coming: low severity, high frequency, high severity, high frequency, high severity, low frequency, and low severity, high frequency. Right? You can take a screenshot of this to understand. Now, how to handle these things? See, high frequency things first, up two boxes where frequency is high. Now, if you see the insurance policies available, if insurance is very high frequency is there for risk, it is difficult to get risk cover for that. Insurance is not available easily for very high frequency risks. Fine. So what you can do here is you can control the risk. You have to control the risk because you cannot take insurance for that. All risk cannot be covered with risk. This insurance. Where we should go for insurance, that we are trying to see. So control risk. How you are going to control it? Try to reduce your risk if severity is low and frequency is very high. Like just suppose you are running a shop. Okay, so shoplifting is there. Some children or some person will come and some piece of sweets or something they will take from your main table, and you will not know, you will not notice it. So that kind of thing is happening every day on every shop. Small thefts. So frequency is very high, but severity is very low because those things what people keep on the front desk is very low price, 1 rupee or 50 paise or 70 paise kind of thing. So a small thing, so loss is not that much. So try to reduce it. How will you reduce it? Install a CCTV camera and mention many places that you are under CCTV coverage. So people will be little afraid of those things. Okay, no need of insurance here. Don't waste money. If severity is high and risk is high, so better avoid it because you don't get any insurance cover for any such schemes, any such risks. Where frequency is high, where severity is high, so avoid it. Like of this bungee jumping, bungee jumping. This kind of jumping is very risky thing. And if you are going for that, no insurance cover will be there. What to do is don't go for this. Or that kind of risky things. The coal mine, people working under coal mine, they don't get any insurance cover because that is very risky and severity is very high. So coverage is not possible. So try to avoid those things where frequency is high, where severity is high. Now, other thing is where frequency is low. If frequency is low, then you go for risk finance. How to risk finance is, first thing is if severity is low, frequency also is low, but severity is very low. Retain that risk. Assume this risk. Digest that. Live with that risk. Like a headache. Being teacher, all of us, during some certain period of heavy works, we get some headache. Okay. So no need of any insurance cover for that, isn't it? It will not happen every day to you. It will happen once in a month or maybe once in a quarter. Okay, and severity also is very less. Headache is there means take 8 hours sleep and you will be fine. Take one casual leave that day if you are really under stress. Take 1 day leave and everything will be fine. Day after next day you will start working as you are working earlier, isn't it? So retain that risk. Continue. No need of any coverage out here. But if frequency is low but intensity, severity is very high, you need to transfer the risk. Don't retain that risk with you. And transferring the risk means insurance. So actually try to see what kind of risks you are exposed to. For these first three risks, you need not go for any insurance. Insurance is meant only for the fourth quadrant, where severity is high, but risk is, frequency is low. Okay, let's go to next. But before that, some questions are there. I will see and I will continue. Is trading illegal for government employees? No, it is not illegal. You can go for trading, but if by trading you mean in the stock market trading, then it is not illegal. But any other business is illegal. Yes, you are not allowed to do any economic activity. But investment in the stock market is not considered as employment. You can do. Some questions are coming for product specific questions, so I will not answer because I should not take name of any products. Is investment in PPF have any benefits? Yes, certainly it is having benefit. One thing is it is every year you are investing some amount, so a kind of regularity is there. That is good. Second thing is it is going to generate more than 7% return. So at least inflation it is trying to beat. And then another good thing is tax saving is there. So it is a good option, but don't feel that it is going to give you very good return. For a very good return, you have to take little higher risk. Here, there is no risk. So no risk, no pain, no gain. If you want to increase your return, then you have to go for some risky products. Go for mutual funds up to some. Do you think NPS retirement amount is sufficient for the service holders? So if you have seen my slide on NPS, I told it is not going to be enough. Not at all it will be enough. So you have to make certain more savings for that purpose. Okay, so NPS will not be complete without. Okay, so I'm going again back to my slides and keep on posting your questions and I will try to keep on taking all these options. Fine. Now this is types of insurance. Let's see all these one by one, but little fast because we are going little back with the time. So general insurance, you know, broadly there are two kind of insurance: life insurance, which covers life, and general insurance. All other insurance which are not covered, which are not life related, that is all general insurance. So general insurance tries to cover everything except life. Death, health is covered under general insurance. Health insurance is under general insurance, not life insurance. Fine. So rest all things are covered under general insurance. Now let's see first the health insurance itself. What happens in health insurance is actually the problem with us is when we plan for anything, we plan sitting when we are fit. And when we are fit, we don't think anything may happen to us and we ignore our health. But that is a place where actually very huge amount sometimes required to manage, right? So we need to cover some part of our health. So take some 15, 20 lakh rupees health insurance by paying some 15,000 or so, whatever insurance premium for that. And if anything is happening, if some hospitalization is required at some later stage, right? So that insurance company will be paying off that. And if you take cashless policy, then you simply report that your card, your company name to the desk of the hospital, and they will directly collect money from the company. You need not pay any cash out of your pocket. Medicines will also be covered here, and your room rent, hospital, if you are taking a special ward, so that rent will also be taken care of. So that may be a good policy to take. Now, if you are having a health insurance, if you are taking, then you can take these add-ons on that. On basic premium, you can take some add-ons like maternity leave cover or pre-existing diseases if you are already having diabetic or if you are already having hypertension. So that may also be covered, but your premium will be little higher. Or accidental cover you can take if accident happens, then some little higher payment. Fine. Now, motor insurance, all of you who are having some vehicle must be well aware of this. If you are having any vehicle, you have to take insurance, like health insurance for myself, for my body, for my vehicle's body. Motor insurance is there. And it is a must actually mandatory. Without taking third-party insurance, you cannot run any vehicle on road. You can run. But other vehicles, you need to take insurance. Right? So, and you know, if anything is happening to your bike uh, or your car damage, then if it is properly covered under insurance, that company will compensate. Right? Now, this motor insurance is of two types. One is called third-party insurance, which is mandatory. You cannot ignore it. You have to take it. Okay. So, and this will not compensate you. If you hit someone, just suppose you are running your bike or your car and you hit a bike of someone else. So bike will suffer some loss, some damage is there on the bike. Now that taker will ask you to compensate, but now this third party insurance is made for that. Third party insurance that biker may compensate or may claim this return from the insurance company. It is properly covered. Fine. So it is to compensate the person to whom you have suffered the loss, not yourself. Comprehensive policy covers third insurance policy plus your also loss also. Okay, so if you are having a new car, a new bike, go for comprehensive policy initially, at least for initial few years, and then later on you can shift to only third party insurance. But it is ideally better to go for comprehensive, considering that anytime any small accident may happen, so compensation better to get. Now, travel insurance, next thing and very important thing. If you are going, especially if you are going out of country, then it is a must. Don't go out of country without travel insurance. Reason is, if anything happens during the travel, you will be compensated by policy. It may be medical expenses, it may be baggage loss, it may be loss, any kind of loss of passport or some other kind of thing. Hijacking is covered under some schemes. Flights are delayed. If you have to catch up, you have to change your flight at the airport and your flight is delayed, you will miss. So that kind of thing will be, and accidental death also will be covered. Now, this policy, this travel insurance is also of two types. It may be single trip policy or it may be annual multiple trip. Single trip means you go, you leave India up to 180 days, you remain outside India, you will be covered. But as soon as you come back to India, your policy will cease to happen. Like just suppose you went for 1 month to one place and you came back, and after 1 month again you went some other place, but your policy will lapse because as soon as you return back to India, that policy will lapse. So one time only, and the total duration is 180 days. But if you are a frequent flyer, if you frequently go outside, then go for annual multi-trip. So it will be for 1 year, 365 days. And if you are out of India, then this policy will be in force. And many time you can come back and you can go. Every month you go once and come back, it will be covered. So that depends what is your case, and accordingly you can go. Within India also, travel insurance you can take. Nowadays, if you take railway tickets, they used to ask if you want to cover some insurance. They ask some 70%, 30%, 50%. Very small amount they ask for that, but some compensation is there. For flights also, some flight delay or some kind of thing, some insurance is there. So accordingly, you think what is fit for you and you can choose. Now, home insurance, which is important, home, because of rupees are invested in home. So we better we cover our home insurance. So this may be two things broadly telling. It may be the structure of house or the details or the things kept in house. Those things may be covered under this. So any kind of loss due to other than natural calamities, other than act of God. We have seen that movie. Oh my God! Then you must be very much clear about the concept, act of God. Other than that, fire, burglary, theft, flood, earthquake. Earthquake, not all policies are covering, but some policies, specific policies which they mention, they may cover it. Okay. So that is home insurance, and these are different types of home insurance. It is standard fire and special risk policy. So if any fire is there in your house, things will be covered, or some other kind of thing, flood or storm or lightning or anything that will be covered. House structure, by name you may identify that it is for covering the structure of the house. If anything happens to the building, not the things kept in the house, it is only those things, the structure only, plus permanent fittings, bathroom fittings are there or some that kind of fittings are there, that also is covered under this. Okay, then public liability coverage. If you keep products of other people in your, like suppose you construct one, say, parking place where 50 cars are parked. It is parked at your place, and if anything happens to that place, earthquake, then who will compensate? All the car owners will ask you why we have taken, so you take care of this. So you can take whole insurance of that park, not that kind of thing if you keep some other. And then contained insurance. This contained insurance will not cover house. If anything happens to house, it will not compensate. But this will compensate whatever the things you have kept, your valuable things, durable things, or jewelry or something you have kept in house. So that will be covered under this policy. Now, fire insurance, by name it is clear if there is any fire, so that loss will be compensated. And these are some common insurance things, value policy, protein policy, very specific policies. I'll not go much in detail. I think I've taken a long time. So let's give a little more time on insurance for life. But before that, some questions are there I will take up and then I will continue. Uh, yes. One is asking return money in motor or bike insurance is very low in damage cases compared to expenses. Is this any measure? Is there any measure? So that is their compensation is that depends what kind of policy you have taken and what is the premium, what are the things coverage is there. So those things are actually going to decide what actually is covered and what how much compensation you will be getting. Fine. Okay, let's go for this endowment plan. You must be knowing, and many among you must have taken also endowment plan. Endowment plan is return some interest part, some return is also there. You pay if any casualty happens, then you get payment for that insurance. And if your policy matures and nothing happens, then you will get some return over there. So it is with return policies. Money back policy is like endowment plan, but endowment plan pays money at the end of the period when policy matures. And money back policies, money back plans actually pays at frequent intervals, every 3 years or every 4 years, some amount it will pay you back. So that is money back plan. Whole life plan is, I will show you one example for whole life plan also. Under this plan, your whole life will be covered. Suppose you have taken insurance till 60 years of age. Okay, so if you survive that age, then at 60 years of age, you will be getting some amount. Policy will mature and some maturity amount you will be getting, like endowment plan. But after that also, your life will be secured without paying any premium. After 20 years, after 30 years, everyone whosoever has born will die for sure. So whenever that person will die, his dependents or her dependents will be getting that insured part of this amount. Okay, so the difference between endowment plan and whole life plan is endowment plan, when matures, money will be paid. In whole life plan, at the time of maturity, whole amount will be paid, but life insurance will continue forever. Okay, then unit linked insurance plan, this is nothing but an investment plan. The premium you pay, some amount goes for insurance and bigger amount goes for investment, and that is invested in a mutual fund. And if mutual fund performs well, then you will be getting return out of that mutual fund. And if any casualty happens, you get money back out of your insurance plan. So actually, this is two things kept together: investment in mutual fund and investment in insurance. Those two things done together. Pension plans are NPS, you can say, is the insurance plan, annuity plan. So it is a kind of pension you invest initially for 10, 15, 20 years, and then some amount back you are going to. And terms plan. Terms plan is actually the best plan. Why I'm telling it is the best plan, someone asked also earlier to suggest a product for insurance. So that is the best plan. Go for term plan, and I will show you some comparison why I am telling so. So term plan actually, if someone has taken insurance and if he survives whole period, he will not get any amount back. There is no maturity amount if policy matures. Fine. But if any casualty happens, it gives much higher return, much higher insurance cover as compared to endowment plan or whole life plan or any other plan. So coverage is very high, but if you survive, you don't get anything back. Right? But how we can manage these things, that I will show with some examples. Okay. Okay. Now that is a common saying. Just to change the mood, I'm showing you this. It is a common saying that seeing is believing. So actually, what happens in the insurance field, you are not being shown the real picture, what insurance you need. Actually, I have already shown you that how less insured our country is. It is really shown. And out of those insurance, think of yourself, what kind of insurance you have taken. I told take term plan. How many of you have taken term plan? How many of you have taken ULIP? How many of you have taken endowment or money back plans? that will tell how much we know about the insurance. So let's see what is seeing and believing. I just as a picture, I was searching on net and I got a picture here. And it was beyond my imagination that how come anyone can do this with that it has big cruelty. But really, if we see the whole picture, this is the case. It is a game only. The child itself is playing. So seeing is believing is correct, but actually it should be seeing complete picture is believing. Try to see the complete picture. When you talk about insurance, try to see the complete picture of insurance. Fine. And here in next 4-5 slides, I will try to widen your vision about insurance. The question is there. I will just see what is that. Okay, someone is telling Pritam Ghosh that I am having term plan. Well done. So why it is good plan now I will tell you. But before that, one more thing why we are not aware about proper policy what we should take is why we should take policy and why we should not is we should take policy only for risk cover, not for any other thing, not for tax saving, not for money future thing, not for a children education, not for any other thing, only and purely for risk coverage. Right? Now, when I was searching on net, I find this information that the policy, whatever you pay premium on regular plans, nearly 7 to 25% of first year's premium goes to the person who, as compensation, as commission to the agent who has sold you that policy. A big amount goes there. Okay, so that's why it's not very wise to go for all these small kind of policies. Go for a better plan and go for a longer period, a bigger amount. And I will show you some comparisons and it will make it very much clear to you. Okay, so insurance premium and tax planning. If you want to plan your tax with help of insurance, what you can do. An example of 30 years of a person and term is 25 years and sum assured is 1 lakh. First thing, I don't assume 1 lakh rupees insurance as an insurance. 1 lakh insurance is maybe your monthly salary, maybe salary more than this. So 1 month salary cannot be an insurance. Assume, keep in mind, insurance is required if the bread earner dies. Fine. This 1 month salary is not enough for anything. So I don't assume it as an insurance. But anyway, let's see tax planning part of this. If you invest in LIC single premium endowment plan, and I am taking example of only LIC because it is a public sector company, and I will compare it only with LIC. I will not go to any other place. So if you invest, you have to pay 46,689 rupees as insurance premium one time to save tax. How much tax you will save is 14. Right? Now, net investment is if you deduct 14,000 out of 46,000, so 32,000 rupees is your net investment. At the maturity after 25 years, you will be getting 2,53,000. Effectively, it is somewhere 8.5% return you are getting. Not bad. 8.5% return is a good amount. But if you invest same amount, 46,689 rupees, same amount if you invest in a mutual fund, and if that mutual fund is able to generate 8% return, and which is possible, 8% return can be generated easily, your return will be 3,20,000 rupees. Here it is 2,50,000 rupees. So 1 lakh, or not 1 lakh, but it is 70,000 rupees higher than that. And if you are lucky to get 12% return, you will be generating somewhere 8 lakh rupees return on that. So if you are planning to save tax, don't go for single insurance. Single premium insurance, go for mutual. Okay, if you invest in PPF, actually this calculation I forget to correct it. It's 7.6 now. Insurance this premium, this interest is reduced to 7.1%. So still it is better than this kind of insurance, right? So don't go for tax planning with help of insurance. Okay, let's compare term plan what I am suggesting with all other plans. Okay, I'm taking case of 30-year person and term is 35 years, and sum assured is 50,000. Sorry, 50 lakh rupees. 50 lakh rupees is a substantial amount, and that can be called as an insurance. Right? So let's see one example. LIC New Jeevan Anand. This policy is available in market. Uh, so premium you have to pay 1,52,852 rupees per annum, or monthly you can pay 13,000 rupees. When it matures after 35 years, you will be getting 2.5 crore rupees, 2 crore 49 lakh rupees. Okay, and it is a lifelong insurance. If you remember, I told you about life insurance, long life or lifelong insurance. So at 65 years of age, you will be getting this 2.5 crore rupees, and your cover will continue. And after 120 years, certainly certain a day, everyone will die. So when the person dies, his dependent will be getting 50 lakh rupees. So altogether, you say 30 lakh, 3 crore rupees is paid on it, right? LIC new endowment plan, another scheme is there, which is not lifelong. It is just endowment plan. So premium here is 1,38,000 annual or 11,770 per month, and coverage is nearly same, 2.5 crores. But lifelong part is not here, see, and that's why premium is little less. So these two are endowment or whole life plan, regular plans. Now compare it with term plan. Term plan again I'm comparing with LIC only. I'm not taking other company, LIC. And here premium is 9,663 only annual. It is per annum. It is not monthly. It is per annum. Right? It's very, very less. But maturity benefit is nil. Here maturity benefit is 2.5 crore rupees. We are paying more, so we are getting some amount back. But I'm telling you, you go for this, take this policy, pay 9,600 here, and remaining amount you invest in a mutual fund, 10,700 rupees per month. I have taken this lower amount out of 1,38,202. If you invest, if you deduct this 9,663, some amount will come, divided by 12. So it will be coming 10,700 rupees. So per month, this much you can invest out of same premium, right? And if you are able to get 10% return on this, which is possible to get in mutual funds, you will be generating over 4 crore rupees per month. In this case, only 2.5 crore rupees. Here it is 4 crore rupees. And if we are lucky enough to generate 15% return, which is little difficult to generate, but then it will be 15 crore or nearly 16 crore rupees. Right? Investment is same. There is no difference. Amount is exactly same amount. But instead of going by this endowment plans, go to this dual plans, term plan plus mutual fund. And this will be good enough amount you will be generating. Okay? Now let's see online plan with offline plan. Both are term plans, but online term plan and offline term plan. Let's try to compare those two first. So first thing is, I'm taking again age 30 years. Term is 25 years, means up to 55 years coverage, and sum assured is 24 lakh. Right? I'm taking example of LIC and more Jeevan 2. Here, per annum, you are supposed to pay 9,540. Survival benefit is nil. No survival benefit because it is a term plan. Fine. If any casualty happens, 24 lakh rupees insurance. Instead of this, if you go for online, this is offline policy of LIC. This is online policy of LIC. Here, premium is only 4,663. Same coverage of 24 lakh. Right? Now, if remaining amount, if you invest in per month 407 rupees, same amount, 9,546 minus 4,663, whatever is coming divided by 12, 407 will come. That you invest every month, 407. And when this policy will mature 25 years, you will be generating 7,72,000 rupees if you generate 12% return. So if anything happens, you get 24 lakh rupees insurance cover. If you survive the period, 7.7 lakh. May not be very big amount after 25 years, but something is better than nothing, isn't it? If you can earn more with same investment, why to settle for less if you can earn for more? Now let's see one more example. 30 years age, 35 years coverage with 50 lakh rupees insurance. So insurance is there, LIC Amulya Jeevan. Here policy you are supposed to pay 15,281 premium per annum, not per month, per annum. Survival benefit nil. But if you go for e-term plan, you pay 9,663 only. And after 35 years, you will be generating more than 30 lakh rupees corpus. Right? So term plan, when I compare offline plan and online plan, so online plan is giving you much better return as compared to offline. So why to invest in offline? Why don't we go for online? Right? Just log into computer, log into the company you want, not necessarily LIC. I told you, I gave you list of 24 companies. Go to their website, check, compare, and choose. Right? Now let's see. There are some pure term plans online and return of premium term plans. What happens in term plan? Actually, we feel that nothing. If I survive, I get nothing. So it discourages. So some companies came out with some policy where they will pay you back your insurance premium. Whatever premium you have paid throughout the period, if you survive, that amount will be paid back to you. It's a good thing. Okay, so let's see that example also. So I'm taking again term plan. Here I tell you that I have not taken it from LIC because I couldn't get a policy comparable in LIC, return of premium. So I've taken it from some other company, but I'm not taking name of the company and name of the policy. But both the examples I'm taking will be from same company. So amounts are comparable. Now here you have to pay premium of 2,751. Insurance is 10 lakh rupees. And this premium is for 10 years. And total premium you pay in 10 years is 27,510. Right? If you take return of premium policy, then premium is for same coverage, it is 32,195. From 2,700, it becomes 32,000. But don't worry because money will be paid back finally. So 3,21,000 is total paid in 10 years. That whole amount will be refunded back to you once policy is matured. So it's fine. No harm in that. So you get refund of 3,21,950 plus a bonus is there, 5 lakh rupees insurance cover will be there for additional 5 years. Fine. But if instead of going for this plan, if the remaining amount like 32,195 minus 2,700, so it will be 29,444. This is the additional amount you are paying. This is the additional amount you are paying. If you invest it, and if you are lucky to get 12% return, you will be getting 5,70,000 rupees. Much more than 3,21,000, much more than your return of premium. So why to settle for just premium? Why don't I go for higher return? You will say 12% is difficult to generate. So why not 4%? 4% saving bank account will pay. Not bank saving account, but post office saving bank accounts are paying 4% return. Put it there and it will generate you more than what this policy is paying, 3,20,000. Here it is 3,62,000. And you know that is easy to do, 6-7% easily you can generate. Right? So no need to go for return of premium policies. Go for pure term plan. And remaining amount you invest somewhere to generate better return. Okay, let's see some more thing. If some bad habits create some problem for us. But before this, some questions are there. Some question, endowment plan or PLI endowment plan, which one is better? So I will not compare products because different companies are having different policies. They are having different schemes. They are different insurance, premiums, different terms and conditions. So it is always difficult. So you have to compare each policies together one by one before choosing. Why agents do not tell about the term plan? And I didn't told this, but I gave you a hint that some 25% premium is going to the agents who sell the product to you. And when you are purchasing term plan, premium they get that commission is less in term plan. And if you take online plan, then there is no middleman. You are directly dealing with company, so you are not paying any commission to anyone. So whole amount is saving for you, and that is why none of the agent will tell you about term plan. Someone is asking if I have invested in insurance but discontinued it. Is there any chance to get any invested amount back? Kindly suggest. And that depends on different companies, and that depends on the policy you are having. Some policies, sometimes they give some chance to revive your policy, or sometimes if you have given more than 3 insurance premiums or 5 or 7, some policies they are having, so some amount you can ask for refund. So that is possible, but each company is having a different policy, and each policy is having different rules. So you have to inquire from that particular company what policy they are following. Fine. So let's continue. Someone is asking again. Okay, so let's go further about some bad habits. That is just beginning of our investment if you want. Let's see. I'm taking one bad habit. Someone, a smoker, who is uh, one price of one pack is say 250 rupees. Monthly expenses of a smoker is, suppose he is taking 2 packs per week, chain smoker. So 8 pack he is purchasing in 1 month. So total 2000 rupees he is investing on cigarettes. And that cigarette is creating a lot of problem inside our body. You know it. So that is a disaster. So why to go for this? Don't go for this and stop smoking, and divert this 2000 rupees what you save on this towards a mutual fund. Okay, so for next 30 years, multiplied with 12 per month for 12 months. So total 360 months are there. So if you divert this 2000 rupees towards a mutual fund, and if your investment generates 12% return, and if your expenses on cigarettes increase 10%, because of tax, actually it increases every year. So if this is true and it is very, very realistic, 2000 rupees on this per month can generate nearly 12% return, and expenses on this increases. If it is the case, then your corpus after 30 year will be 1.2 crore rupees. It is not lakh, it is 1.2 crore rupees. 1 crore 20 lakh 40,420. This saving will come only by quitting cigarettes. So one way you are removing one danger to your life, cigarette, and then you are generating saving. Fine. Let's see. Insurance that cigarettes, not only that, some more differences are there on insurance premium itself. Okay. LIC e-term plan, again, same example what I have given earlier, I am taking. So for 50 lakh rupees insurance premium for 30 years of age, for 35 years, 9,663 rupees premium is coming per annum. Example I have already given. But if that person is non-smoker, then only this will apply. If he is a smoker, then he will go in aggregate category, and that aggregate category, everything is same. Premium is 12,000, nearly 13,000, 12,978. Okay, so you are paying some 3,000 more on that policy if you are a smoker. So every month, every year, you are paying additional amount for that. But if you are not a smoker, then, and if you transfer this additional amount, 3,315 for remaining 35 years, so you will be generating, you can generate up to 80 lakh rupees. Okay, so see the benefits of quitting. So why to start this if you can do much better without it? Fine. Let's take even bigger example of bad habits. Here I am taking some assumptions. Assumptions are, an addict is there who is 30 years old now. His life expectancy is 80 years. If he survives up to 80 years of it, means 50 years more is there. And if his expenses are growing 7% per annum, that will happen. And investment return is generating 12% return. Considering these 4 items, I am taking something. Bad habits we are taking is tobacco, alcohol, and junk food. Three items. And junk food, almost everyone is taking, and other two, actually, these two come together. So many are having these habits. Some expenses I am estimating assumptions that on tobacco, 10 rupees per day, it is very realistic, I think. It is much maybe lesser than, more than that, which people are spending. Alcohol, 500 per week, and 100 rupees per day on junk food. It is very, very realistic, I think. All pizzas and all momos, all are junk foods only. If you put all these things and transfer this amount to a mutual fund, you will be generating altogether 36 crore rupees. How you are generating this 36 crore rupees? By quitting these bad habits. Your health will be better. No more travel to Vellore and Ames. Your saving will be there. Plus this much of saving by diverting the money. Fine. So these may be the way to quit all those bad habits and save yourself from bigger disasters. Now, this is the list of the companies, what I told, one LIC and 23 private sector companies. So these are those 24 companies. And this you can get from IRDA annual report. IRDA means Insurance Regulatory and Development Authority. So government organization which regulates insurance sector. So this, if you see on this, this is claim settlement ratio. Claim settlement means how many claims came and how many they have paid. So first one is paying 99% of the claims. What number of claims are coming? 99% are settled. Second company is also 99, 98, 98. So these are high settlements are there. LIC is 97.8%. 97.8% policies are settled. But if you compare number of claims, number of policies, then you will come see the difference. Fine. So that is the thing, but these are not very important things. If you have properly disclosed everything, if you're not given any wrong statements, then your policy will mature. Fine. But before taking any policy, you should see all comparisons. So this is also one of the comparisons. Don't go for the companies where settlement ratios are very less. Fine. Okay. So let's go further. Now a few more slides only are there. So we try to finish in time. Okay, so insurance, one more example for why not we go for insurance, life insurance. I'm talking. Taking one real life example, a car is there where sum assured for the car is 3,35,000, 3,36,000. Insurance premium will come at 13,157, which is 3.92% coverage. And term plan, e-term plan for 50 lakh rupees, you are supposed to pay only 16,600, which is 0.34% only. It is very, very cheap to take a term plan, but still people are not going for this. Reason is awareness. That is a must. So I hope I have given you proper awareness about term plans. So think of this, and when you purchase next plan, consider taking term plan, and especially online. Now, some steps how we can purchase it. First, you try to know your needs. How much insurance coverage you need. That depends on your annual income, your annual expenses, and the length of life. So some calculations are there that again will take half an hour to explain. So I'm not making that. But some calculators are available on internet. You can go directly and calculate your insurance need. Right? Try to understand how much insurance coverage you need. Okay, then get the important details. What kind of insurance you are taking? If it is life insurance, then details of yourself. If it is motor vehicle, then all papers and all documents. If it is home insurance, then papers for that. So all important details you have to collect for this. Then check the options available to you. So different companies, 24 companies are there for life insurance. Many companies are there for general insurance. Compare their policies. What are the policies there? What are the features available for those policies? So compare all those things. Okay, so compare the benefits, check the add-on, what add-ons are possible there. Don't forget to read the exclusion. What is not covered, certainly read those points. Usually these points are given in very small fonts so that you don't read, but try to read with magnifying glass. What is not covered under this? Then what is the sum assured? Compare it with other policies. What are the any extra thing if it is there? So compare it before purchasing anything. Now pick the right plan after comparison. Get the plan that best suit your requirements and reach out to the company offering the plan for purchase. And then pay the premium, fill the application, pay the premium, read each and every points written in that. Don't leave it on insurance agent. Fill yourself everything. You can do it online if you want to go for online policy, and you can buy it from a dealer also, from a broker also if you are going offline policy. Right? So in conclusion, some points to just to highlight what we already discussed is insurance is meant only for risk cover. Don't try to manage your tax planning. Don't try to do any investment planning with help of it. Take insurance only to cover risk. Term plan is the best life insurance plan. That explanation I have already given because policy amount is premium amount is very less. Remaining amount, if you invest properly, you can generate very good corpus. So it is the best policy available. Go only for term plan. Every income earner having dependent should take insurance cover. Instead of should, I should say must take, or rather I should say ought to take. It is your duty to take insurance cover. Never club insurance with investment. So I will not take name of any policy, but don't invest just for return purpose, just for risk purpose you cover. Never take insurance policy to save tax. And study different policies before choosing anyone. So read about the policies before taking a particular policy. So see what are the exclusion, what are the coverage and everything before doing any other thing. Right? So at last, maybe the last slide actually, Mahatma Gandhi told once that in the new millennium, there will be enough for everybody's need, but not for everybody's need. So don't be greedy, but don't be worried also. Everything will be fine, but we need to plan accordingly and everything will be fine. So, all thanks to you all for joining. And I will just stop this here. Some questions I think are there. Oh, Minga is there.
Yes, I'm here, sir.
Okay, okay. So any additional question is there which I have not covered? I think most of the questions I already answered.
Yes, you have answered all the questions, sir, if I'm not
Okay,
mistaken.
okay, okay.
Yes. So thank you so much, sir, for that one.
Minga, before you
Yes.
ask, one more question is there.
Oh,
That
okay,
is
okay.
fixed deposit plan of insurance is better than fixed deposit in bank. Fixed deposit plans of insurance is better than fixed deposit in bank. So I'm little confused what exactly he wants to ask. Insurance or investment? Don't mix. So if it is insurance, go for insurance, pure insurance. And if it is fixed deposit, go for fixed deposit. Or if you are getting additional same return is there and you are getting some insurance, sometime LIC or some companies are coming out with this kind of policy that premium investment means return is same, plus you get some insurance also. So no harm in going for that. But keep your mind in your mind that return is not very high in that case. If you are investing for return, fixed deposit is not a place. Mutual fund better for that. Yeah. Yeah.
Thank you so much, sir, for that wonderful session. And everybody was, really commenting highly on this session, as it was really beneficial to them. In fact, sometimes, it is one of the purview of commerce and management to study about the awareness level of, the general public on insurance, mutual funds, and even especially in our state, our level of awareness is very, very
Very low.
low. And Yes, it is not only among the uneducated, but also as well as the educated population are also still very unaware of many aspects that we have seen today. So thank you so much, sir, for that
Ah,
wonderful session. A really eye
thank you.
opener for each one of us, I am sure. So thank you so
Thank you.
much, sir, from the organizing team.
Thank
Thank
you.
you so
Thank
much,
you.
sir.
Thanks for inviting me. Thanks.
Thank you, sir. Mhm.
Okay, take care. Bye bye.
Take care, sir. Nice. So, dear participants, with that, we end today's session of lectures, and I'm sure that all of us have benefited greatly from the lectures we have listened today. And I will see you all tomorrow again for a wonderful day again tomorrow. So, thank you so much, everyone. Have a great evening and have a good day. Thank you. Thank you so much.
Thank you. Thank you.
Thank you, sir.